Welcome back to the Deep Dive. Today we're doing what we do best, taking a complex stack of investment sources, articles, proprietary research, academic studies, and really just distilling the strategic, non-obvious analysis.
The kind of analysis that separates, let's say, the casual investor from a true capital allocator.
Exactly. And today we are moving past the routine quarterly reports, past the glossy investor decks, to dissect a structural consolidator, National Storage Affiliates Trust. Ticker is NSA.
That's right. And for the sophisticated investor tuning in, our mission today is really tailored for that critical assessment. We are intentionally looking beyond simple FFO per share growth. We're evaluating NSA through, well, the unforgiving supply-side lens of the capital cycle framework. The question we have to answer is fundamental. Is this company built to weather the current normalization with a durable competitive advantage, or was it merely a leveraged financial structure built for that exceptional low-rate, high-demand world we saw between, 2015 and 2022?
So let's be really clear about the mission here. We need to understand whether NSA is a long-term generator of, let's call it, intrinsic competitive superiority structural alpha, or if it has simply been, and maybe remains, just a highly leveraged bet on the self-storage industry itself.
On the industry beta. Yes.
And to do that, we have to start with the foundational concepts, because you just can't understand the stress they're under now without understanding the behavioral mistakes that created it. So let's establish that analytical foundation that really guides every deep dive of this nature, the capital cycle approach. This perspective, it forces us to abandon those easy demand narratives and shift our focus entirely to the supply side.
To supply dynamics and critically capital allocation discipline.
So why is this framework so fundamentally important for assessing, a capital-intensive aggregated business like a REIT?
It's the essential guardrail against behavioral error. I mean, the capital cycle framework, popularized by analysts at Marathon Asset Management, it exists specifically because it rejects demand-side optimism.
Which is the easy story to sell.
Oh, it's the easiest trap for any investor to fall into. It's comforting, It's comforting to believe that demand for a product is just inelastic and infinite. And in the storage sector, look, the demand story is compelling. It's structurally sound.
Of course. Everyone knows the classic drivers, the structural, demographic certainties, the 4Ds.
Exactly. Death, divorce, downsizing, and displacement. We live in a society that accumulates goods faster than it can get rid of them. Storage per person has just exploded over the decades. That is the secular tailwind.
No one's arguing against that long-term trend.
No, but the capital cycle doesn't care about the long-term merit of the asset class. It focuses on the medium-term outlook and the central paradox of success.
The idea that high profits are, in a way, inherently self-destructive.
Precisely. The core thesis is this. High profitability is the single most powerful gravitational force for attracting capital. It just is. When self-storage delivered, staggering 15% to 20% OI growth during the COVID phenomenon.
Unheard of numbers.
Right. That profitability didn't just attract public REITs. It drew in massive amounts of private equity, sovereign wealth funds, regional developers, a flood of capital. And this influx, it inevitably leads to overinvestment, a glut of new capacity, and then the subsequent painful mean reversion in returns. For a company like NSA, regardless of the great long-term demographic trends, the medium-term outlook, say, the next 3 to 5 years, it is structurally constrained by the sheer volume of capital that rushed into this sector. They are now, quite literally, digesting the consequences of that excess.
That concept, that success breeds its own failure, it brings us to an academic warning sign that should be just flashing bright red across the balance sheet of any consolidator like this.
The asset growth anomaly.
The asset growth anomaly.
Yeah.
So tell us about the mechanism. What is actually happening there?
This is so critical because it moves beyond just, anecdote into established financial science. The asset growth anomaly describes the inverse relationship between a firm's aggressive asset expansion and its subsequent long-term stock returns.
So the faster you grow your assets, the worse your stock does later.
On average, yes. Companies that aggressively deploy capital and rapidly grow their asset base, often fueled by cheap money and a high stock price, they tend on average to dramatically underperform firms that are more judicious, more selective, or even firms that are contracting their asset base.
Which is completely counterintuitive. It fundamentally contradicts the prevailing Wall Street growth mandate. Why does this anomaly persist? Is it just that they're bad at running the new assets, or is there something more systemic going on?
It's systemic and it's behavioral. Studies by academics, Cooper, Gulen, and Schill come to mind, and it's been championed by practitioners like Jeremy Grantham. They show that management teams tend to be overly optimistic about their ability to absorb and integrate new assets.
Right. The synergies never quite materialize as planned.
Exactly. And furthermore, they tend to acquire assets precisely when their own cost of capital is low, which almost invariably coincides with peak valuation in the broader market. So when management aggressively leverages a high stock price to acquire, they often end up paying peak private market prices for those assets.
And NSA,
Yeah.
they stand right at the epicenter of this risk. Their whole identity was built around maximizing asset growth.
Absolutely. NSI's initial differentiator, the participating regional operator or PRO structure, it was explicitly designed as a rapid structural consolidation mechanism. It was engineered to facilitate external growth faster than any traditional M&A could. They essentially placed a very large bet on maximum asset growth.
But the danger, as the sources point out, isn't just the growth itself, it's the timing. It's the pro-cyclical nature of that growth.
The timing couldn't have been worse from a capital cycle perspective. I mean, look at it. NSA's most aggressive period of expansion was between 2020 and 2022.
The peak of the bubble.
The absolute peak. Let's remember that environment. Cap rates, which were already low, compressed even further to historic lows. You saw deals getting done below 4% in premium markets. This coincided with the highest demand confidence in the sector's entire history. So they were issuing equity and debt, exchanging OP units at the exact moment industry valuation was peaking.
So if they acquired assets at implied cap rates of, say, 5.0% during the boom, and today, replacement costs suggest an adequate return requires more like a 7.5% cap rate.
Then the resulting fade rate of returns that decline toward the mean, it's going to be painful and it's going to be rapid, especially when you combine it with high leverage.
It's the definition of magnifying your exposure. They gorged on assets at peak pricing, and now they have to digest those assets in a high cost of capital world where the underlying operational returns are contracting.
That is the asset growth anomaly in action, plain and simple.
That macro-level theory about oversupply.
Yeah.
It leads us right to the practical consequences on the ground, which it seems to reflect a classic economic problem, the prisoner's dilemma in self-storage capacity.
Mm-hmm.
So why can't the handful of major publicly traded players just exercise some restraint, maintain pricing power, especially if they are all aware of this oversupply risk?
Because the self-storage market structure prevents it. It's just not an oligopoly. The top 5 REITs, sure, they might control a significant portion of the institutional-grade facilities, but they're competing with thousands, maybe tens of thousands of independent, fragmented operators.
These small mom-and-pop shops.
Many are smaller, often family-owned players who aren't publicly reporting or subject to the same quarterly scrutiny. They operate entirely outside the collective consciousness of, the capital cycle analysts on Wall Street.
So this fragmentation means that any kind of collective tacit collusion to restrict new supply it's just mathematically impossible.
It is. Every individual operator has a rational, short-term incentive to maximize their own capacity through new development. If everyone acts in their own rational, short-term interest, the collective long-term outcome is the capacity glut that we are currently seeing play out.
And this is where NSA's structural role becomes, non-obvious and maybe a little insidious. Because while they largely grow through acquisition rather than ground-up development, they have an indirect but profound role in fueling that very oversupply.
That is the key structural problem inherent in the consolidator model. By offering regional developers a liquid, tax-advantaged exit strategy through the PRO structure, even before they internalized it, NSA indirectly de-risks the entire development trade for private capital.
Okay, so you're arguing that knowing a ready public exit vehicle exists, one that offers these lucrative OP units instead of just cash, that actually lowers the barrier to entry and encourages private capital to build more supply than they otherwise would.
It accelerates the cycle, absolutely. The private developer builds a new facility, betting that within 3 to 5 years it will stabilize, and NSA, or a similar consolidator, will be there to acquire it. This feedback loop makes NSA an engine for the very supply glut that is now eroding the rental rates of the assets NSA already owns.
That's a structural conflict.
Okay.
The consolidation strategy accelerates the capacity expansion.
That ultimately deflates the value of the acquired assets. It's a snake eating its own tail.
Okay, so that theoretical lens gives us the context.
Yeah.
Now let's drill down into the operational ground truth. We are shifting from a period of exceptional returns, a structural anomaly, to what feels like a painful but necessary normalization.
Right.
I mean, the historical foundation of storage is strong. We went from 1 square foot per person in the 70s to nearly 8 square feet today. But the COVID shock, that created a temporary operational monster.
We have to call 2020 through 2022 what it was, a freak phenomenon. It was completely divorced from normal structural trends. The pandemic created these massive artificial demand spikes.
Driven by societal dislocation.
Exactly. I mean, think about the sudden need for space. You had people fleeing dense urban centers, setting up ad hoc home offices, needing temporary storage for furniture or, business inventory. This created an ephemeral but immense surge that drove operator occupancy rates into the mid-90% range.
And occupancy in the mid-90s in real estate that's like peak capacity in manufacturing. It means operators have almost unassailable pricing power.
And that's why we saw same-store NOI growth explode to those unheard-of levels, 15, even 20% annually.
And this is where investor psychology led to the misallocated bet. The critical mistake was, what? Extrapolating those temporary returns.
It was treating the COVID shock not as a dramatic one-time pull forward of demand that saturated the market, but as a permanent new structural floor for growth. The eventual reversion to the mean was a mathematical certainty once that exogenous shock faded and, people settled into their new locations.
So now we're seeing the brutal operational symptoms of this normalization. The first is this 1-2 punch of collapsing street rates combined with what you're calling a critical churn risk.
It is the single biggest threat to organic revenue growth for NSA right now. I mean, industry data confirms that street rates, that's what a new customer pays when they sign a lease today, have declined by mid-teens percentages from their 2022 peak levels.
But at the same time, operators like NSA were trying to maximize short-term cash flow, defend the dividend.
So they aggressively hiked rates on their existing customers. The process known as existing customer rate increases, or ECRI.
And this creates a widening and increasingly dangerous bifurcation in their ledger.
Exactly. You have the existing customer who maybe signed their lease at a low rate and has now endured 2 years of aggressive 10 or 15% hikes. So they're paying a high in-place rent.
Right.
Meanwhile, the new customer signing a lease for a unit right across the hall is getting a deep discount on the street rate. As that gap widens, as the existing customer realizes they're being charged 25% more than the person next door, the behavioral inertia that kept them put is suddenly overcome by simple financial savings.
The hassle factor of moving your stuff out of a unit, which has always been the traditional moat of the storage business, suddenly becomes quantifiable in dollar savings. That's the churn risk.
High churn risk means the erosion of all those past high ECRI gains. If that existing customer moves out, NSA has to replace them at the new, lower street rate. They essentially lock in a revenue loss. This is why we're seeing same-store NOI not just decelerating but actively declining. The number cited is down 5.7% year over year in Q3 2025.
So that tells you the churn effect and the rate compression are already overwhelming any residual growth.
They are.
And compounding this revenue compression is the return of broader occupancy pressure. That mid-90s peak is now retracing back toward the sector average. The number we have is specifically 84.5% in Q3 2025. This isn't just a simple loss of marginal revenue, is it?
No.
It triggers the dreaded negative operating leverage. We should explain this clearly for the sophisticated investor listening.
This is the critical financial nuance. Real estate is fundamentally a high fixed cost business. The vast majority of your costs, property taxes, insurance premiums, debt service payments, centralized G&A, they are fixed. They do not decline when one unit goes empty.
So when occupancy slips, say, from 95% down to 85%, you lose that marginal high profit revenue, but your fixed costs, they remain 100% intact.
Precisely. So the decline in revenue is proportionally amplified when it hits the net operating income line. If NSA's NOI margin is historically 70%, meaning 70 cents of every dollar of revenue is profit, a 5% drop in revenue can easily translate into an 8% or even a 10% drop in FFO.
Because that revenue decline flows directly against that static fixed cost base.
That is the definition of negative operating leverage. High fixed costs create a multiplier effect that accelerates earnings loss when the top line shrinks.
And the company is navigating this operational headwind, falling rates and rising fixed cost pressure against the certainty of rising interest expenses, which is the cost side squeeze we'll get to later. This is a double whammy environment.
And we haven't even factored in the supply lag effect yet.
Yeah.
This is the delayed reckoning of the capital cycle. This is the point where all that 2021 euphoria physically materializes into new competition.
The new facilities that were planned during the cheap money era are now stabilizing and delivering right into this softening 2024 and 2025 market. This isn't hypothetical supply, right? This is concrete competitive capacity coming online now.
And we can quantify this and ground it geographically. I mean, the analysis shows that this new supply is disproportionately concentrated in high-growth, lower-regulation Sunbelt markets metros in Texas, Florida, parts of the Carolinas.
Areas that saw a huge population influx and developer enthusiasm.
Right. We're talking about regions that now have 18 to 24 months of existing supply coming online in the near term.
That's a significant amount. And that competitive density forces all existing operators, including NSA, to just lower their street rates even further to defend market share.
It becomes a race to the bottom in specific micromarkets. If NSA bought an asset in, say, Dallas in 2021 based on underwriting stabilized cash flows, and now 2 new shiny facilities open within 3 miles.
The math breaks.
The underwriting math for that expensive acquisition breaks down almost instantaneously. The supply lag effect actively works to deflate the value of assets they acquired so aggressively during the peak of the cycle. NSA's strategic focus on buying stabilized assets, rather than building their own in less competitive spots, makes them acutely sensitive to this delayed supply.
So we've established the theoretical risk, the capital cycle, and the operational pain, this normalization.
Yeah.
But the ultimate metric for a sophisticated investor is always the durability of the competitive advantage.
Yeah.
So we have to ask, does NSA have a defensible moat against the industry giants, especially given that self-storage is, at its core, a commodity?
It is the quintessential commodity. I mean, the analysis confirms that a 10 by 10 unit at an NSA facility is functionally indistinguishable from one at public storage. Customer choice is driven almost exclusively by 2 things: proximity, how close is it to my house, and cost. So since the product is commoditized, the moat cannot be product quality. It has to reside somewhere else. In operational efficiency, superior data, or a structurally lower customer acquisition cost, or CAC. And when we stack NSA against the titans, the competitive differentiation looks weak.
Let's start with U-Haul, ticker UAL. They present a classic logistics-based network moat that NSA, frankly, cannot replicate even if they wanted to.
U-Haul operates in a fundamentally different space. They are a logistics network first, and they have a self-storage business built on top of it. They operate over 23,000 locations across the U.S. and Canada. This creates an unassailable network effect.
Ubiquity.
Ubiquity. You capture the customer at the peak moment of need, which is at the truck counter.
So that truck network is the ultimate feeder for the storage business. It's captive demand.
Exactly. The data suggests that roughly 25% of U-Haul's truck rental customers also require self-storage. U-Haul captures that demand organically right at the point of sale, whether it's at the physical counter or on their proprietary website.
Meanwhile, NSA has to go out and compete in the extremely expensive, highly contested digital auction.
The Google ads, the SEO, the bidding wars for self-storage near me in every single major metro.
Which just means U-Haul operates with a structurally and demonstrably lower CAC. And in a commoditized sector, the low-cost acquirer of customers, they always win. It forces NSA to perpetually spend more for the exact same customer.
And there's more. U-Haul has integrated pricing flexibility. They view the storage rental and the truck rental as a combined profit center, so they can afford to be more aggressive on one or the other, which allows for steadier, less volatile pricing and, potentially better customer retention. They're capturing value through ancillary services, moving supplies, insurance, truck rentals, not just squeezing every last dollar of rent through aggressive ECRI hikes.
Okay, now let's pivot to their pure-play rival, Public Storage, PSA. NSA has to beat PSA operationally, but PSA's advantage is just scale, data, and ruthless efficiency.
PSA is the market hegemon. Their sheer scale translates directly into a massive proprietary data advantage. I mean, they generate colossal volumes of data on everything. Pricing elasticity based on zip code, time of day, competitor moves, customer behavior. They can optimize their algorithmic pricing down to a science, which maximizes their revenue per available square foot, or RevPAF, in every market. This is a level of data sophistication that smaller, historically decentralized players like NSA, they just can't match overnight.
That centralization also drives operational efficiency. which is evidenced by that staggering margin gap that every critical investor has to focus on.
The margin gap is the physical manifestation of the competitive difference. PSA runs centralized operations. They aggressively deploy unmanned or unattended facilities, digital access technology. All of this allows them to rationalize labor costs, and that drives their best-in-class NOI margin, which consistently sits around 78.5%.
Okay, now contrast that with national storage affiliates.
NSA consistently posts inferior NOI margins. The number we have is 69.0% in Q3 2025. That is a 950 basis point gap in operational efficiency.
9.5 percentage points. That's not a rounding error.
No, it is structural and profound. It indicates either highly inefficient labor and process management, probably stemming from its historically decentralized PRO model, or it means they own lower quality assets. Perhaps older, higher expense assets in secondary markets that simply cost more to run and maintain. Either way, to justify its valuation, NSA needs a miracle to close that 950 basis point margin gap.
Which brings us right to NSA's primary historical differentiator, that participating regional operator or PRO structure. For a long time, this was lauded as their unique moat, right? Proprietary deal flow, local management alignment, a tax-efficient acquisition currency.
Right.
But the capital cycle critique reveals this was maybe less of a moat and more of a financial arbitrage tool. We need to detail the actual mechanics of this for the listener.
It was pure financial engineering built for a zeroed RP, a zero interest rate policy era. The mechanism was ingenious. Instead of paying cash or common stock to regional operators who contributed their stabilized portfolio, NSA issued them operating partnership units, OP units.
And how does an OP unit differ critically from just getting common stock?
The key is tax deferral. The issuance of OP units allows the sellers, these regional entrepreneurs, to contribute their highly appreciated properties to the REIT in what's called a 721 tax-deferred exchange. They avoided massive immediate capital gains taxes.
So this created a high-powered, tax-deferred acquisition currency for NSA that was incredibly attractive to sellers.
Incredibly attractive. The arbitrage wasn't just the spread between NSA's public cost of equity and private cap rates. It was the tax efficiency that allowed them to transact so cheaply and so often.
But as you said, this moat completely disappears when interest rates rise.
It evaporates. Once NSA stock trades at a discount, its cost of capital rises, the arbitrage spread shrinks, and suddenly the PROs are much less incentivized to accept those OP units, particularly since a discounted stock means a deferred tax bill that will eventually be paid on a less valuable asset. A moat built on financial engineering, not operational superiority, is highly cyclical.
And the single biggest, most irreversible event that eliminated this proprietary engine was the internalization of the PRO structure. They completed that in July of 2024.
That was the strategic pivot. NSA shed its unique external growth pipeline for a generic centralized model. They're essentially trying to become a standard pure-play operator in the PSA mold. Now, they have to compete head-to-head with those giants, but without their competitive benefits. They are fighting PSA without the data, fighting U-Haul without the logistics, and they gave up their proprietary deal flow to do it.
Wait, hold on. If the PRO structure was such a unique differentiator, why did management choose to internalize it now, right before the economic downturn and the supply glut really manifested? That sounds like management giving up their most defensible acquisition channel just when they needed it most. Was this timing a massive misstep, or was it a necessary consolidation?
That is the core debate, isn't it? The bear case argues it was a necessary consolidation, but the timing was just disastrously pro-cyclical. The theory behind internalization is simple. You eliminate the management fees paid to the PROs, you achieve economies of scale, and you create the centralized platform necessary to finally close that 950 basis point margin gap with PSA.
So it was an attempt to transition from a financial aggregator to an operational efficiency machine.
Correct. But they chose to do this during peak operational stress. The timing meant they sacrificed their proprietary acquisition pipeline right when private market cap rates were still sticky, and they incurred massive integration costs during a period of contracting revenue.
And those costs are real.
Oh, they are. Those integration costs, by the way, jumped 25.4% in Q3 2025, a significant headwind to their already precarious FFO coverage. They are paying a very high price for a generic structure at the worst possible time.
Okay, moving to the balance sheet and management decisions. The ultimate test in this high-rate, low-growth environment is capital allocation discipline. For NSA, a company built on external growth, the current environment presents a devastating growth dilemma.
The external growth engine is, well, it's fundamental constrained, if not completely frozen. NSA's historical growth relies on accretive acquisitions. That means they have to acquire assets at a higher cap rate than their overall cost of capital.
Simple enough.
But, as we discussed, private sellers are suffering from cap rate stickiness. They're anchored to the fantasy of 2021 valuations. They refuse to sell at the higher cap rates demanded by today's 4.5% 10-year Treasury yield and the associated 7% cost of capital.
So the price mismatch is absolute. Sellers demand peak pricing, and NSA can't justify buying at those valuations without destroying shareholder value.
And this is the moment where the asset growth anomaly risk becomes behavioral. If management, facing intense pressure to show FFO growth and justify their compensation, forces acquisitions by overpaying or issuing expensive equity in this constrained environment, they are actively destroying per-share value. And the temptation is enormous because of the structural agency problem inherent in REIT management.
Let's define that agency problem clearly for our listeners. What are management's incentives here, and how do they conflict with shareholder value?
In many REIT structures, management compensation is heavily weighted toward metrics tied to size. Total assets under management, or AUM, total FFO, overall market cap.
Empire-building metrics.
Exactly. It incentivizes empire building. They are structurally motivated to issue equity and acquire assets, even if those actions are marginally dilutive on a per-share basis, because it increases their AUM and guarantees a fatter compensation package.
Yeah.
Maximizing AUM often conflicts directly with maximizing per-share efficiency, which would involve value-maximizing actions like share buybacks. So the investor has to view every acquisition decision through the lens of this incentive structure.
And moving from acquisitions to the core financial structure, we encounter what seems to be the most precarious element of NSA's current financial health, the dividend trap. As a REIT, NSA is legally bound to pay out 90% of its taxable income, which severely limits retained earnings and operational flexibility.
And the financial detail from Q3 2025 is stark. It represents the highest probability event risk. NSA reported core FFO per share dropped to 57 cents.
Okay.
They maintained the dividend exactly at 57 cents.
Oh.
That means the payout ratio hit precisely 100% of FFO. And because of non-cash adjustments like depreciation, it is almost certainly significantly higher than 100% of actual net income.
A 100% coverage ratio leaves absolutely zero margin for error for a high fixed cost business.
Zero. This strongly implies the dividend is unsustainably being funded through non-operating means. Either they're issuing debt, drawing down cash reserves, or maybe recycling capital through strategic, non-core asset sales. Given that same-store NOI declined 5.7% in Q3, the mathematical probability of FFO dropping below 57 cents in the coming quarters, especially with rising interest costs, is near certainty.
So what are the immediate consequences if they do have to cut the dividend?
A dividend cut would be the highest probability event risk for the stock price. I mean, REITs are often owned by income-focused investors, retirees, yield funds, you name it. A cut triggers an immediate sharp sell-off as these income-focused funds flee the stock, regardless of whether the cut was actually the prudent capital allocation decision. So management is fighting tooth and nail to avoid this, but the numbers suggest that fight is rapidly being lost.
And compounding this problem is the balance sheet structure itself, specifically the high leverage. NSA operates with a high net debt to EBITDA ratio of 6.7x.
Compared to Public Storage's typical conservative 4x.
That's a huge difference, and it limits all their defensive capability.
High leverage is toxic in a high-rate contracting earnings environment. It limits NSA's ability to play offense. They can't aggressively buy distressed assets when the cycle finally hits bottom, and it magnifies their interest rate exposure. Critically, roughly 22% of their debt is floating rate or variable.
So that immediately translates any Fed policy decision straight into FFO reduction.
Instantly. And the certainty of the future debt refinancing wall is a ticking clock. They're going to have to replace low-cost ZRRP-era debt they perhaps secured at 3.5% or 4.0%, with debt price today at 7.0% or 7.5%.
That is a material structural step change in interest expense.
It requires substantial operational outperformance just to offset it. I mean, let's quantify it. To absorb that increased interest expense, which could easily be $30 or $40 million annually, NSA needs to generate 5 to 7% sustained same-store NOI growth just to maintain their current FFO level.
Which is simply not possible in the current normalization environment where street rates are collapsing and supply is increasing.
So they're effectively running in place while sinking.
So given these severe constraints, the critical investor needs a playbook. We need to monitor which capital allocation scenario management chooses, because that will signal their discipline or lack thereof in navigating this part of the cycle?
We have three primary signals to watch for. The first and the most bearish signal would be aggressive growth. If management attempts to force acquisitions by issuing expensive equity, ignoring the cost of capital, ignoring the supply glut, they are prioritizing empire building over per share value. That signals a total lack of capital cycle awareness.
The second, a defensive crouch, is maybe neutral to cautiously bullish.
I'd say so. A defensive crouch means halting acquisitions entirely, focusing laser-like on operational efficiencies to close that margin gap, and most importantly, prioritizing paying down debt to delever the balance sheet. It sacrifices the growth narrative, but it preserves financial integrity.
And the third, the truly bullish signal, the one that would indicate a pivot to real shareholder value creation, rather than just management size.
That would be true capital recycling. This involves selling lower quality, high expense assets, say the bottom 10% of the portfolio, and using the proceeds not to fund the unsustainable dividend, but to fund aggressive share buybacks. This aligns with the academic concept of the asset contraction anomaly, exploiting the discount to net asset value.
So if management demonstrates the discipline to shrink the company to maximize per share value rather than grow AUM,
that signals a real pivot toward value investing. The investor has to be monitoring management for this shift, but that high dividend payout makes it extremely difficult to execute this efficiently.
all right, let's consolidate these financial and operational risks into a valuation perspective. The sector has undergone a massive derating. Multiples have compressed from around 30x FFO at the 2021 peak down to NSA's current, 13x FFO?
Around there, yes.
This compression begs the essential question for our audience. Is this now a value stock, or is it a classic value trap?
The bear case, informed by the capital cycle, points strongly toward a value trap scenario. And here's why. That 13x FFO multiple is misleading because it's being applied to peak earnings. Earnings that were temporarily boosted by the COVID-era occupancy highs and those aggressive ECRI hikes.
We know those earnings are already contracting.
Yes, core FFO per share is already contracting, down 8.1% year-over-year in Q3 2025.
So if the denominator of the FFO is contracting, a seemingly low multiple of 13x rapidly becomes much higher relative to future normalized or contracting earnings. The market is pricing in a contraction that hasn't fully played out yet.
Precisely. And the most significant, immediate, and potentially catastrophic valuation risk is the cap rate cliff. This centers on the gap between the public market's pricing and the stubborn reality of the private market cost structure. Let's anchor this clearly.
We know the 10-year Treasury yield, the risk-free anchor, is hovering around 4.5%.
Historically, for a cyclical real estate asset like self-storage, the market demands a risk premium, a spread of around 300 basis points over that risk-free rate. So therefore, the required cap rate for a stable storage asset today should be approximately 7.5%.
Okay, so that's the required return. Now, where is NSA actually priced?
The public market, via NSA's current stock price, is pricing its assets at an implied cap rate of somewhere between 6.5% and 7.0%. This suggests the public market has already factored in some asset markdown. However, the private market, suffering from that severe cap rate stickiness we mentioned, is still trying to transact, albeit very thinly, around 6.0% to 6.5%.
This is the danger zone. The major valuation risk is that those sticky private market cap rates must eventually adjust upward to that required 7.5%. It's a non-negotiable economic reality set by the cost of debt.
And an adjustment from, say, a 5.0% cap rate, which was the peak underwriting assumption, to a 7.5% required cap rate. That implies a catastrophic 33% decline in the gross value of the underlying real estate assets. Even a shift from the current 6.5% implied rate up to 7.5% implies a massive value erosion.
And this is where NSA's high leverage, that 6.7x net debt to EBITDA, becomes the equity value magnifier.
It accelerates the pain. For a company like NSA, which is approximately 30% levered, a 28% decline in the underlying asset value is magnified substantially. It doesn't just cut your equity in half, it could wipe out approximately 40% to 50% of the equity value when you calculate it against the balance sheet. The latent balance sheet risk created by this cap rate cliff, combined with 6.7x leverage, means you cannot simply look at 13x current FFO and call it cheap. You have to price in the high probability of asset impairment and subsequent write-downs.
Finally, let's address the turnaround thesis that management is currently pitching. They've consciously chosen to shed the unique PRO structure and are attempting to become a standard, centralized operational efficiency machine. This means NSA is now fundamentally a high-risk, show-me story.
It is a massive strategic bet. The entire investment thesis now rests on management successfully completing the complex, multifaceted internalization, integrating all those disparate regional PRO systems, and this is the key, driving the operational efficiency necessary to close that 950 basis point margin gap with public storage.
And the integration costs alone are already biting, up 25.4% in Q3 2025. That suggests complexity and execution risk are high.
They are very high. If this centralized platform fails to generate immediate and sustained synergies, or if the fragmented, scattered portfolio proves too complex or too low quality to manage effectively under a unified umbrella, the entire synergy thesis collapses. They have traded a unique financial advantage for a generic operational advantage they have not yet proven they can execute.
And their recovery thesis isn't even driven by internal operational certainty. Management explicitly stated that their portfolio is more levered to a housing recovery than peers.
That is the ultimate confession of reliance on macro factors. Their 2026 outlook hinges entirely on external events, a sharp improvement in housing velocity, declining interest rates, a massive inflow of new population that restarts the cycle. This makes NSA a speculative macro play on rate cuts, rather than a high-quality, operationally efficient compounder that controls its own destiny.
So they're effectively asking the investor to time the bottom of the housing and rate cycle.
Which is a very difficult game to play. So our final assessment is that National Storage Affiliates Trust is a company that acted aggressively, utilizing a fair-weather financial structure that was highly sensitive to the low cost of capital. They gorged on assets during the boom and are now forced into a difficult, high-stakes digestion phase in a high-rate, normalizing environment, entirely lacking the deep proprietary moats of their major competitors, Public Storage and U-Haul.
The choice for the critical investor is sharp then. Is the current discount to FFO sufficiently justified by the immense structural risk, the punitive 6.7x leverage, the operational headwinds of the supply glut, and that exposed 100% covered dividend? Or does the market eventually reward this as a deep cyclical play, assuming the required housing recovery arrives promptly in 2026? It requires a high degree of confidence in macro timing, which is inherently speculative. The capital cycle framework counsels extreme caution. They aggressively acquired assets when capital was cheap, and they are now forced to undertake a painful and expensive operational pivot precisely when capital is expensive and organic earnings are contracting. The timing is fundamentally unfavorable. So the question for your portfolio, regardless of whether you own NSA or not, becomes this. Given that the publicly traded financial markets are currently forcing NSA's implied cap rate to 6.5% or 7.0%, a figure significantly higher than the 6.0% to 6.5% implied by recent sticky private market transactions, who is ultimately proven right.
Is it the publicly traded financial markets, which mark asset values down quickly and brutally, or is it the slow to adjust private real estate owners? And what would that ultimate painful cap rate adjustment to the required 7.5% mean, not just for NSA, but for every other levered real estate holding in your current portfolio that relies on debt and valuations established in the previous cycle? That's the true deep dive into systemic risk. We'll see you next time.